Hi guys, welcome back to In Case of Econ Struggles. Welcome to another AP Micro Struggle. In this video, I'll be talking about topic 3.2, which is about short-run cost functions. In the next video, I'll be talking about long-run cost functions, so if that's what you're looking for, that's the next video. And again, if you're finding these videos helpful, please consider subscribing. So what are we going to talk about today? Well, today we're going to talk about the 4 things that you need to know about short-run cost functions. So we're going to talk about fixed and variable costs. Talk about average costs. We'll use an example total cost function and talk about how we get all of these costs. We'll also talk about marginal cost and the marginal cost function. You don't need to know how to get the marginal cost function for this class, so don't worry about how to calculate that. We'll just talk about what it means. We'll also talk about marginal product and marginal cost, how those two things are related. And in addition, we'll talk about how marginal cost and average costs are different and the relationship between those two costs. And finally, we'll draw a nice graph with all of these short-run costs on one picture. So timestamps are below if you would like to jump around, but let's just jump right into it. Before we dive in, let's just do a motivating example. Let's talk conceptually about the types of cost functions. So here's Bill. Bill is going to own an ice cream store. So here's Bill's ice cream store. And Bill's ice cream store, as he runs his business, he has a couple different types of costs. He's got fixed costs and he's got variable costs. So what is the difference between fixed cost and variable cost? Well, fixed cost is not going to depend. It's not going to change as the amount of ice cream that Bill produces changes, but variable costs, those costs will go up as Bill produces more ice cream cones. So that might be something like wages, how much he's paying his workers. If he wants to make more ice cream, he's got to pay more people. If he's paying more people, he's paying a higher overall cost. For electricity, supplies, and inputs, again, all of those things he's got to have more of. He's got to use more of those things to make more ice cream. If he uses more of those things, his costs are going to go up. So both Bill's labor and his input costs are going up as his output changes, so that's what we call variable cost. Fixed cost is not going to change depending on whether Bill makes 0 ice cream cones or 100 ice cream cones. So if he makes 0 or 100 ice cream cones, his fixed costs stay the same. He can have the same fixed cost, so what is that? Well, something like rent. Bill probably doesn't own the building, probably rents the building from a landlord. And whether or not Bill is in there making ice cream cones or not, Bill's got to pay that rent every month because he has the building. Maybe the city, maybe he's in a small town that requires a business license. Every year, Bill's got to pay a certain amount of money to City Hall for that business license. That would be a fixed cost because, again, if Bill makes 0 ice cream cones or if Bill makes 100 ice cream cones or even 1,000,000 ice cream cones, in order to run that business in the town, he has to have a business license and he's got to pay for that. So that's a fixed cost. So that's sort of conceptually what fixed costs and variable costs are. Now let's look at a cost function and break that down numerically. So here's the cost function. Maybe it's Bill's cost function. Bill's cost function is going to be a cost of the amount of ice cream cones that he makes. That's going to be 100 plus 2q squared, where again, q is just the number of ice cream cones that Bill is making. That's just a stand-in for ice cream cones. So what are his costs? Well, first of all, this is his total cost function. It's his fixed cost plus his variable cost. You can see I'm using different colors for different types of costs. So maybe again, this is his rent plus his business license sort of fees. And this is the total cost for his supplies, his electricity based on the number of ice cream cones that he's making. And it's 2q squared. So just like we said before, this 100 is the fixed cost. This 2q squared is the variable cost because it's got q in it. Now, maybe we want to ask the question, and with all of these other cost functions, we're basically trying to answer a particular question about Bill's business. So maybe we ask the question, okay, Bill, how much on average per ice cream cone does it cost you to make an ice cream cone? And all we're going to do for that is we're just going to take this total cost and we're going to divide it by quantity. So if I take total cost and divide it by quantity, I'm going to get the average total cost. And you might imagine that the fixed cost over quantity is just going to be what we call the average fixed cost. So I just take this 100, I divide it by Q, and I get the average fixed cost, which you see right here. Same for the variable cost. If I take variable cost and I divide it by Q, I'm going to get the average variable cost. So I take 2Q squared, I divide it by Q. One of these Q's cancels, and I get to 2Q, which is the average variable cost that you see here. So again, average total cost, average fixed cost, plus average variable cost. We're asking the question, if I take the total cost and I divide it by the total amount of ice cream cones that I make, then I get an idea of how much on average it costs me to make each ice cream cone at a particular number of ice cream cones that I'm making. Now we're going to ask the question of how much does Bill's total cost change if he makes one additional ice cream cone. So remember in economics, anytime you see one additional ice cream or one additional something, We're talking about margin, talking about a marginal something. What is the margin of? What is the marginal something? We're asking what changes. Well, we're saying that the total cost is changing, so this must be the marginal total cost, which we just call the marginal total cost. And what you really need to know is you only need to know how the variable cost is changing. Why is that? Because we said that fixed cost doesn't change based on how many ice cream cones we're making. So if I go from 1 ice cream to 2 ice cream, my fixed cost is still like $100. So my fixed cost doesn't change. So the only thing that changes when I make more ice cream cones is this variable cost. Again, for this class, you're not going to need to know how to calculate the marginal cost from the total cost function. If you do find that your teacher is asking you to calculate marginal cost from the total cost function, drop a comment below and I will explain how to do that. But generally for the AP test, you're not going to need to know how to do that. And again, we'll cover this a little bit more also when we do the profit maximization problem. Now, marginal cost and average cost is not quite the same thing. They mean different things conceptually. Remember that marginal cost is 1 additional ice cream cone. The average total cost is how much on average per unit of output my total cost is. So you can see those definitions are not the same, but it still might be a little confusing. So let's step away from the economics and use a non-econ example. So here's what I want you to think about. I want you to imagine that your average total cost curve is just your overall GPA. Just whatever your GPA is right now on average, and your marginal cost is going to be your grades this semester. So you can see, maybe if we use Deb as an example, let's say that this is Deb's GPA and Deb's grades this semester. If Deb is trying to figure out how her grades this semester will affect her GPA, she's going to draw something like this, and let's talk about why this makes sense. So in region 1, which is this marginal cost line or grades this semester, below the average total cost or her overall GPA, this means that Deb's grades this semester were worse than her overall GPA. What happens to your GPA overall if you get worse grades than your overall GPA? Your GPA goes down. So this is just saying that as the marginal cost is under the average total cost, it's sort of pulling your average total cost curve down. It's decreasing. Now in region 3, you can see that Deb's grades this semester are actually higher than her overall GPA. And if your grades this semester are higher than your GPA, what's happening to your GPA? It's going up. You're pulling up your GPA with your grades this semester. So when your marginal cost curve is above your average total cost curve, you are pulling the average total cost up. And what happens to Deb's GPA if her grades this semester are exactly equal to her GPA? Well, nothing's going to change. Her GPA is not going to change. So it must be the case that her marginal cost and her average total cost are going to cross at the minimum of the average total cost. Because her GPA is not going up or down, it's staying the same. So that must be at the minimum. So again, if we apply this back to economics, what this says is that marginal cost is not the same as average total cost. And what it says is that marginal cost will cross the average total cost curve at the minimum of average total cost. Comment below if this didn't make any sense, but hopefully this gives a better explanation of the difference between marginal and average cost. Now let's sort of put 2 concepts that we talked about together. The first is going to be diminishing marginal product, which we talked about when we talked about factor markets, like your labor market, and the fact that when you add more workers, they increase the amount of output that you can make, but on a decreasing basis. So in the short run, the only way that Bill can increase quantity is by increasing the amount of workers that he has or the amount of supplies. And that's going to get really, really costly as Bill increases the number of ice cream cones. So what's going to happen is if I draw a line like this, and I say that this is the marginal cost, and this is the amount of ice cream cones that Bill wants to make, it's going to look something like this, where as Bill makes more and more ice cream, marginal cost, or the cost to make an extra ice cream cone, is just going to go through the roof. And I'll show that graph again in a minute. But really what you need to know is that diminishing marginal product means that you have increasing marginal cost, which means that as you make more and more ice cream, the cost to make one more ice cream is just going up and up and up. Means your cost overall are going up and up and up. So here are those 2 graphs just drawn again. So here's labor against quantity on the left, and you can see that as I hire more and more people, I'm producing more output, but less and less each time, which means my marginal product is decreasing if I think about the change in quantity when I change labor over time, where the extra quantity I get for an extra worker is going down and closer to 0 every new worker I hire. And if that is happening, then I need to hire more and more people as quantity gets way out here. The cost to do that is going to be really high, which is why my marginal cost curve is going to look something like this. So that's all we're trying to say, is that the marginal cost is increasing at an increasing rate because I have diminishing marginal product of labor. So now that we have that all done, let's put all these cost curves together on one graph. Here's the marginal cost curve that we just talked about. And again, it's going to go through the average total cost at the minimum average total cost based on that GPA example. Now, average fixed cost is just a number divided by Q. So if I take a standard number like 2 and divide it by Q, as Q gets higher and higher and higher, this average fixed cost is going to go to 0. So that means that average variable cost is the difference between average total cost and average fixed costs, because remember that average total cost is equal to average variable cost plus average fixed cost. So if this is going to 0, then average total cost is going to become average variable cost. And you can see the gap between average variable cost and average total cost getting to 0 as Q gets really, really large. Again, for the same reason as that GPA example, average variable cost and marginal cost cross at the minimum of average variable cost. This graph is going to be super useful later when, again, we start talking about profit maximization. I know this is sort of a long video. Comment below if you have questions, but if this was helpful, make sure to like and subscribe, and we'll see you next time for another case of Econ Struggles.